This is a new video, this time the topic's floating exchange rates as an example of a market-orientated strategy that could influence growth and economic development. So say what it is. So what is a floating exchange rate? If we start right at the very beginning with the absolute basics, an exchange rate is the price of one currency compared to another. More specifically, an exchange rate measures the quantity of foreign currency that can be bought with one unit of domestic currency. A market is a place where buyers and sellers meet for the purpose of exchange. In Forex, or FX, or whatever you want to abbreviate it to, basically stands for the same thing, foreign exchange markets. So in these FX, Forex markets, buyers and sellers of different currencies meet to exchange currencies. So an example might be you've gone to the airport at a particular point in time to go on holiday, maybe to Ayia Napa. You've budgeted that to have a good time, you'll need so many Cypriot pounds. So you go to the airport and you do a Forex transaction. You sell pounds to buy all the Cypriot pounds that you need to have fun on the island of Ayia Napa. So in the past, most Forex transactions undertaken by households happened in banks or at bureau de change booths at airports. Today, that situation's changed. The bulk of the world's Forex trading now takes place electronically via the internet. A floating exchange rate describes a situation where a government and/or a central bank allows market forces to determine the value of a currency on Forex markets organically, according to market forces of supply and demand. Officially, sterling is a good example of a floating currency. This is because, officially, the Bank of England doesn't intervene in Forex markets to manipulate either the demand for or the supply of sterling. So sterling is demanded by foreign nationals who want to buy British goods. So that's what's driving the demand for sterling. People like my father-in-law, he'll come to visit England from Finland. He'll want to drink his Guinness in the pub. So before he comes, he'll need to demand sterling because he won't be able to pay for his beer in the pub with euro. So he'll have to sell euro to demand or buy sterling before he comes. Sterling's also bought by firms overseas that have purchased British exports, or maybe it might be a foreign investor who wants to buy shares in a UK company, or maybe they want to buy property in London. To enact that transaction, the foreigner doing the buying has first of all got to enter into the Forex market and demand sterling. So in summary then, the demand for sterling on Forex markets is driven by foreign nationals who want to buy either British goods, services or assets. So that's on the demand side. On the supply side, sterling is supplied by UK nationals. Why would British people want to supply sterling on Forex markets? Answer is it's not altruism or kindness. Basically, you will supply sterling onto the Forex market in order to obtain the euros, dollars or yen needed to purchase a foreign good, service or maybe a foreign asset that you want. Like, if you were interested in buying a flat in New York, you couldn't rock up to New York and try and buy the flat in pounds. You'd obviously have to sell sterling in order to buy the dollars needed to purchase the asset of the American who's selling it. So the supply of sterling is determined by UK nationals and our desire to own foreign assets, foreign goods or enjoy foreign services. That's when we supply our own currency. to obtain the foreign currency that we need in turn to purchase imports and foreign assets that we like. So markets, as you know, come into equilibrium where supply equals demand. So in this market, the exchange rate is going to come into equilibrium naturally at ER1. That would be the floating exchange rate in this situation. And the equilibrium quantity of currency traded would be Q1. So this is how floating currencies work. They're organic, they're determined naturally by market forces, by the relative strength of the supply and demand for a particular currency on these global FX, Forex, foreign exchange, whatever you want to call them, these currency markets. A floating exchange rate appreciates when it buys more foreign currency than it did before. Exchange rate appreciations are caused by either A, an increase in the demand for the currency concerned, so we can show that with the rightward shift of the demand curve. That in turn will force the exchange rate up from ER1 to ER2. So exchange rate appreciations occur when a unit of your currency buys more foreign currency than it did before, and one possible cause is an increase in the demand for your currency. So that could typically arise if you become a more successful exporter. If you're exporting more, people will have to pay you more for the extra stuff that you're selling them. So to pay those British firms, foreigners abroad will have to first of all purchase more sterling on Forex markets, causing the demand for sterling to increase and our exchange rate to appreciate. The other option, of course, is a decrease in supply. That will also cause sterling to appreciate. So what could cause that? Well, basically it might be because British people are buying fewer imports or they're buying fewer assets abroad. So because we're buying fewer imports, our demand for foreign currency has dropped. So if we don't need as much foreign currency, we don't need to sell as much of our own currency into Forex markets, explaining why the supply of sterling decreases. So again, whether it's an increase in demand or a decrease in supply, you'll get an exchange rate appreciation as shown on the diagram there from ER1 to ER2. Floating exchange rates depreciate when a country's currency buys less foreign currency than it did before. Exchange rate depreciations are caused by either a decrease in the demand for the currency concerned, so that would cause the exchange rate to depreciate, fall, as you can see from the diagram. So that normally happens when a country is struggling with its international competitiveness. It's exporting fewer goods and services, and because of that, the demand for its currency on Forex markets has dropped too. You know, people don't need to buy as much sterling if they're not buying as many British exports or UK assets even. Exchange rates can also appreciate when Brits go on a spending spree, when they start purchasing lots of imported goods and services. To buy those imported goods and services, somebody's got to sell sterling in order to buy the foreign currency needed to pay for the goods and services where they've been produced abroad. And to get hold of that extra foreign currency, Brits have got to supply more of their own currency, pound sterling, which explains why the supply of sterling's increased there from S1 to S2, which causes the exchange rate to fall. So what we're really saying here is that floating exchange rates have just got a natural tendency to depreciate when a country suffers from an international competitiveness problem and its exports are falling and its imports are rising. So say why it might work. So what we're trying to do here is try to explain why a floating exchange rate might help a country to achieve either economic growth or economic development. This really will depend on the situation, and at this point it might be best to look at a particular country facing a particular problem and do our analysis in some sort of context. So let's take the example of Britain. Due to supply side weaknesses that are far too many to mention, the UK's international competitiveness has been deteriorating for years. The UK runs a current account deficit, which means that our import expenditure is greater than our export income. Therefore, the net exports component of British aggregate demand is negative, which makes it harder for the economy to achieve the increases in aggregate demand that Keynesians say are needed to generate short-run economic growth. So how might a floating currency help Britain to achieve higher rates of economic growth? Let's see if we can look at this. As we've already seen, a country that's struggling with an international competitiveness problem will automatically experience an exchange rate depreciation if their currency is allowed to float. This is because poor export sales will reduce the demand for its currency on forex markets. And then also importing too much will mean that a country will have to supply more of its own currency on forex markets to obtain the extra foreign currency needed to purchase all the imports that it wants to consume. When an exchange rate falls, export prices will decrease. As a result, the demand for exports will extend. We'll sell more of them. We'll sell a greater volume of exports. Hopefully that will lead to an increase in export income. At the same time, a currency depreciation will also increase import prices. If import prices go up, domestic citizens will buy fewer imports, which will hopefully reduce import expenditure. So what we've established at this point is that a currency depreciation will lead to an increase in export income and a fall in import expenditure, all being well. This will reduce the UK's current account deficit. If the X minus M component of AD becomes less negative, aggregate demand will increase from AD1 to AD2. So I'll just show you that now. There it is. And you could argue that certainly at the moment, due to COVID-19, unemployment's been soaring. Surely there must be loads of spare capacity in the British economy at the moment. Keynesians assume that if that is the case, firms will respond to an increase in aggregate demand by producing more rather than by raising price. So if that's the case, the end result will be short-run, non-inflationary, export-led economic growth of MY1 to MY2. So in a nutshell then, this is what we're basically saying, that if you've got a floating currency and you've got an international competitiveness problem, you could benefit from a natural automatic stabilizer effect. If you allow your currency to float and you've got a competitiveness problem, it'll tend to naturally float downwards. And that will help your own companies to get price back into their export markets, and also it will price out cheap imports from your domestic market, and that should create short-run growth. So that's the argument in favour of floating exchange rates. Just let it float downwards when you've got a competitiveness problem, and that will automatically create an automatic stabilizer effect, which is export-led growth. So, in summary, let us go on. So, why might it not work? What are the drawbacks? Why might a floating currency fail in this regard? Why might there not be economic growth following a currency depreciation? Well, the answer really is it all depends on the price elasticity of demand of a country's imports and exports. And if you're a bit, I don't know, maybe if you think that your knowledge isn't so great on that area, maybe you should go off now, just stop the video and do a bit of revision about price elasticity of demand, because if you don't really understand that properly, this won't make much sense to you at all. So I'm going to continue now, assuming that you do really understand what price elasticity of demand is all about. Okay, so as I say, let's go on assuming that is the case. So allowing a floating currency to depreciate, it won't decrease a country's current account deficit if the demand for a country's imports and exports are price inelastic rather than price elastic. Due to deindustrialization, it's almost certainly the case that the UK's demand for imports is price inelastic. A weaker sterling will definitely increase the price of imported goods sold in British shops. Theoretically, UK consumers will attempt to avoid more expensive imports by switching to domestically produced substitutes, which will now look cheaper in comparison. Unfortunately for the UK, due to deindustrialisation, there are not many domestically produced substitutes left for most of the products that we routinely import. Due to this lack of substitutes, the demand for UK imports will be highly price inelastic. So we'll look now at what the impacts will be of higher import prices if the demand for UK imports is price inelastic rather than price elastic. So in a nutshell, the problem is that higher import prices will actually increase UK import expenditure if the demand for UK imports is price inelastic. So again, from last year, we should know that total expenditure is equal to price times quantity. The UK's import expenditure is currently equal to P1 Q1. You can see that on the demand curve that I've drawn there. Notice that I've drawn the curve so it looks quite steep, because what I'm trying to illustrate is a situation where the demand for UK imports is price inelastic. So let's imagine now that the price of UK imports goes up because we've got a floating currency that's been allowed to depreciate. So the price of imports goes up from P1 to P2. So what that will do is it will cause a contraction of demand from Q1 to Q2. So the volume of imports will actually fall, the quantity, the volume of imports will fall from Q1 to Q2. But if we actually look at import expenditure, imports by value, not by volume, you'll actually see that import expenditure will have gone up, because the new import expenditure is now going to be P2 multiplied by Q2, which is a lot higher than P1 multiplied by Q1. So we've got this situation then that we've allowed our floating currency to depreciate. We hoped it's going to divert demand towards domestically produced substitutes. That really didn't happen because there weren't too many of those. So what's actually happened is the demand has hardly contracted, and so as a result, UK import expenditure has actually risen, because the percentage increase in price from P1 to P2 it was greater than the percentage fall in quantity from Q1 to Q2. So we could maybe see if we can make this even easier. So let's substitute some numbers for the letters. So if we assume that P1 was £2 and the original quantity Q1 was 200 million units, our original import expenditure would be £2 times 200 million, which is 400 million. What happened then is prices went up. So P2, we're going to give that a figure of £6. There was a little contraction, so Q2's dropped from 200 million to 190. So our new import expenditure is going to be a 6, the new price, multiplied by the new quantity, 190 million rather. So you can see that import expenditure has risen from 400 million to 1,140 million. So this just shows you that when price rises on a price inelastic demand, total expenditure on that product will go up. Again, if you're just interested, you could actually work out what the price elasticity of demand would be in this case. So the falling quantity demanded was 10 on an original of 200, so that's a fall of 5%. The price increase went from £2 to £6, so that's an increase in 4 on an original of 2. So that's a 200% increase. So if you put those figures into your PD formula, you get a highly price inelastic demand figure of minus 0.025. So in practice, for a country like the UK that's got an international competitiveness problem and a price inelastic demand for its imports, a floating exchange rate that depreciates wouldn't be a great help. It certainly wouldn't be beneficial to allow sterling to depreciate, because if we did that, our import expenditure would rise rather than fall. And as a result, rather than the UK's current account deficit falling when sterling depreciates, the opposite would happen, and Britain's current account deficit would get even bigger. And that's typically what's been happening over the last 10 years or so. Sterling's been depreciating against most currencies. Most Keynesians assume that the demand for our exports and imports is price elastic. So they always predict that the current account deficit is going to get smaller, but then they always get surprised when the opposite happens, and a weaker sterling just leads to soaring UK import expenditure because there's not many substitutes for the stuff that we currently import. So when import prices go up, when sterling depreciates, our import expenditure gets bigger, our current account deficit gets bigger, and the X minus M element of British aggregate demand becomes even more negative, which depresses or drags down our aggregate demand total still further, in this case from AD1 to AD2. So rather than GDP and employment rising, it does the opposite. It falls and you have a recession. So what does it depend on? Well, if you're going to go for an exchange rate that's just allowed to float, everything really depends on whether your demand for your imports and exports are they price elastic or price inelastic.